If it goes down, you can see that you're going to win 100% of the time on this trade. But even if it goes up, you're still going to win about 80% of the time on this trade. You got a lot of room for it to go up. So if we're wrong that, this market is still going to stay crazy bullish. Spread. So some of you are concerned that the market is going to drop and you want to start doing some more kind of bearish trades. And you can always buy a put, or which we're going to be less than a 50-50 shot. You can buy a put spread, which is most of the time going to be less than a 50-50 shot, or you can sell a call spread to be bearish. And if you sell a call spread the same way we sell put spreads, you are trying to be right directionally, but you don't need to be right directionally to still win. As long as you're not completely wrong, the market moves in a huge way, you should still win. So for example, I'm using this SPX so we can see the curve view. But if I went over here on this SPX, and keep in mind the all-time high is like 61. Let me just double check what the all-time high is, the SPX here. 61.28. And so if we go, let's just say we decide that we're going to go to a 10 delta here, and we're going to do a no more than a 20-point Y spread. So we got a 20-point Y spread there. We're collecting $200. The most we can lose is $1,800. That's how much you have to put up if you're using the SPX. But you're getting $200 on the trade. So on your return on your capital, if you take the 200 divided by the 1,800, that is 11% return on your capital. So it's not the 12 that we want, but it's close, right? So I would still call it non-standard because it's not the 12 that we want. But this is not a bad trade at all. And if you wanted to figure out how far you're away from at the money, I'm just giving you all the kind of criteria here. So if we normally want to be at least 5.5% away from at the money. So if we take this number and we subtract it from this number and we divide it by that number, that's the last price, right? So we take the 63.50 minus the 60.24 divided by the 60.24, we have 5.4%. So that's almost meeting at least at 5.5. And so this would definitely be non-standard, but it doesn't look like a bad trade because the delta is the most important thing for us. But if you want to be more conservative and meet the standard that we have for our call spreads and our put spreads, you're going to meet all the criteria. The percentage from at the money, the delta, the capital required that you're receiving, at least $100 after fees and commissions, and at least 12% return on your capital. Okay. Now, with this trade, the market would have to go past all-time highs, about a little over 200 points higher than the all-time high in the next 43 days. Can it do it? Yeah, it's saying it's a 10% chance it's going to expire above the 63.50 in the next 43 days, and it's a 20% chance it's going to touch, because probably a touch is 2 times the delta. So you take that 10 times 2, that would equal 20. So it's a 20% chance it can be touched. So your odds on your side that you're not going to even be touched, right? Because it's only a 20% chance you're going to be touched. So 80% chance you're not going to even be threatened on the trade. You're not going to have to adjust it or whatever the case may be, right? 80% chance you're not going to have to adjust this trade. You're bearish, and if you go to this curve view here, the great thing about this bearish position is that, I know it's all these different other things that's here, but disregard that stuff. Just look at this. This is the at the money line, this where I'm putting this yellow at. If it goes down, you can see that you're going to win 100% of the time on this trade. But even if it goes up, you're still going to win about 80% of the time on this trade. You got a lot of room for it to go up. So if we're wrong that, this market is still going to stay crazy bullish, right? Regardless, it doesn't matter about the new administration's policies, good or bad, doesn't matter. The market is already at all-time highs. It's already at historical highs based on price to earnings ratios for these companies. So we could drop regardless of what all the other factors may be or may not be. So when you're doing this call spread, you could be wrong directionally and still win. That's why we love to be the primary option seller, because most of the time, statistically, you're only going to be right 50-50 on your direction, right? Some of us is less than that, right? I've been joking around earlier that I've been crazy wrong about the earnings plays. I've been less than 50-50. I mean, like 33%. I've just been crazy wrong. We're going to go through periods like that. But if you go through those periods and you still have significantly high odds on your side that you're going to make some money, even if you're wrong directionally, then that's how you can become a consistent trader. That's how you can become a consistent winner. That's how you can start counting on a certain amount of money each month, each week, each quarter, depending on how you set up your trades. I love this on the put side, you guys know, because on the put side, you can usually be so far away percentage wise because the risk with stock indexes is skewed to the downside. That's where the risk is at. So you can be at the same delta. Let's say on the call side, the delta on the call side, 10 delta is 5.4% away. Well, that delta on the put side at the 10 delta could be 8% away. It's a bigger distance percentage wise. Same delta because the risk, the velocity of the moves to the downside are stronger than the velocity to the moves of the upside. But we do drift up more than we go down. We do go up more than we go down, I should say. So that's why I don't like to do as many straight out call spreads. Obviously, we do iron condors a lot with the short term trades and so forth. But when I'm doing bread and butter days, 30 to 60 days out, closer to 60 most of the time for me when I'm initiating a trade, I don't like to just do single call spreads a lot. I'm usually like, maybe 20 put spreads to one call spread or something because the market has that tendency to drift up. When things go wrong, you have the Fed that can jump in with a lot of different policies. You got the government, that can jump in with a lot of different policies. The world does not, or at least, and I'm talking about the world to say the United States markets. Right now we control the world markets wise. We really don't want to go down. Everyone, almost all money is leaning bullish. All the big money, what they call real money, the institutional money, the endowments, the the huge hedge funds, the huge mutual funds, they're all bullish, and so that's why you have this. And plus the interest free, risk free rate, it's leaning, it's bullish. So I try to be a lot more vigilant, a lot more careful on the call side because of that fact, and because you can't get as far away percentage wise. But you do have times where you think that the market should go down. And I want to caution you on that thinking process. You still want to be vigilant because of what I just said regarding how the world is bullish, how the US markets, which are the markets of the world, are bullish. So you have to be careful with that call side. Even when you're leaning a lot, when you're leaning very bullish, in your mind, you just say, "There's no way this market can go down. Excuse me, go up. There's no way this market can go up." Well, that's when the market does this old adage, it kind of climbs the wall of worry. And it just does things that you don't think it should. You think to yourself, it's not, it doesn't make any sense. Just like when you do an earnings play and a company comes out and the earnings just seems horrible, but the stock goes up, or the earnings seem just phenomenal and the stock goes down. You can't be dogmatic about your stance with these markets. So you give yourself some room for error and then trade based on the quantitative process of, okay, I have the green zone, yellow zone, and the red zone. Regardless of what I think, I'm already deep in the red zone. I can't continue to think this is going to go down. I have to make my adjustment because I could be wrong and I have been wrong to this point. And if I get more wrong, it can be a substantial loss because I'm so dogmatic about my stance that this is market is going down and it's clearly not. Don't get that way. That's why we have this kind of rule-based process, this quantitative process, because we all have assumptions. We all think we know something, but the market can prove to you time and time again you know nothing.
Hey, O'Brien, quick question.
Yes.
How can you ladder this type of bread and butter? You said you go out 45, 60 days, whatever. How can you ladder them so you can have multiples on, or should you not do that until one expires?
So I absolutely love the laddering process, Dave. Absolutely love it. And so I'm going to answer your question here, but I also want to point out because I'm not going to be able to give in great detail this morning. But if you go to the video library, which everybody as a Dorian Trader member should have access to, and if you go down here and you find the bread and butter strategy, that type of topic here, and you click here, and we have a video on S&P laddering strategy. Check that out. and that's going to help a lot with understanding the process. But yes, you can do that, and I love it because you're diversifying by time, by expiration periods. If if I have something on that's expiring in 30 days and the market goes crazy, doesn't mean that's going to affect the 60-day trade. Doesn't mean it's going to affect the 75-day trade or the 125-day trade. And so you diversifying yourself by time. So if I had a trade on with 43 days, I can decide, okay, well, I'm going to put on a trade with, you know, 54 days, and then I can decide I'm going to put on a trade with 70 days, and I decided I'm going to put on a trade with, 134 days. I've been mentioning a member named Charles who does the safeguard strategy. I said it has been doing great with it. He also ladders with with the ES, and that's been doing very well for him. And so it's and he's so far away. He's trying to be, most of the time at least 15% away on that put side when he's doing something. And so that gives you so much room for error. You do not have to be right. We don't play that game, you guys. We play the game as what is the market not going to do instead of what the market will do. It sounds like a subtle difference, but that's a huge difference. Most people are playing what the market will do. And that's to me is a overall, most of the time losing game. Play what it's not going to do. You bet it on what is not going to happen. And so the market falling 15% in 45 days is not impossible, but it's just not, it doesn't happen often. 5% or less of the time that's happening. And so you're betting on what's not going to happen.